More than $10 billion in reported losses last year. That is not a movie plot. That is real money taken from real people. Some were retirees, some were founders. Some were students chasing a dream. Fraud does not look like a villain in a mask. It looks like a friendly mentor, a polished website, or a dazzling app. It moves so fast. It flatters. It pressures. Imagine your savings melting away while the pitch keeps sounding safer every minute. Could you spot the danger before you click send or sign that transfer? Today you will learn clear red flags that have protected countless investors in the United States, the United Kingdom, and beyond. The next minutes may save your money. Ready to test your radar? First, the origin story of scams will surprise you. Let us start with the shape of modern investment fraud. It hides in plain sight. In the United States and the United Kingdom, the same patterns recur. A promoter promises steady returns with low risk and special access. They add urgency and exclusivity that spike fear of missing out. Regulators have warned about these tactics for years. The Securities and Exchange Commission and the Financial Conduct Authority publish alerts that explain how schemes approach victims and where money disappears. The message is clear. If an offer is not registered or not authorized, your protections shrink. Registration means the seller files required disclosures. Authorization means the firm has permission to do regulated business. Both impose rules on conduct, capital, and custody. Custody is who holds your assets. Segregated client accounts keep client funds separate from company money. If custody is vague, loss can be sudden. You will also hear classic names. A Ponzi scheme pays old investors with deposits from new investors. When new money slows, the structure collapses. A boiler room is an aggressive call center that pushes shares or tokens with false claims. Advance fee fraud asks you to pay a setup cost to unlock a larger payout later. Pump and dump hypes a traded asset until the price spikes. Then insiders sell into the surge. After the dump, small investors hold near worthless units. Technology changed the stage, not the script. Fraud now runs through influencers and dashboards. Some scams borrow a brand name or display fake audits. Others misuse terms like stablecoin or yield farm to sound modern. Stablecoin suggests a token designed to keep a steady price. Yield farm suggests a cluster of tactics to generate returns. Neither term guarantees safety. The essential test remains simple. Where does the return come from? Who controls the assets? Can you verify both claims through independent records? Good actors invite scrutiny. They point to filings on official registers and explain risk in plain language. Bad actors hate time and evidence. They rush you, shame your questions, and push you onto private chats. Once you know these patterns, you can spot them early. The next step is the playbook scammers use. Because once you know the steps, you can break the spell. Here is the usual playbook. It begins with attention capture by a confident guide in a video or private message. They mirror your goals and claim a secret edge. Next comes social proof through client stories and polished screenshots that mimic statements. Then comes authority through job titles, research badges, or celebrity praise. None of this proves a product is lawful or safe. Stage 2 is the low barrier test. You are asked to move a small amount to watch the system work. They call it proof of funds. Proof of funds shows cash exists. It is not a license to skip due diligence. You open an account on a site that looks like a broker or an exchange. Cloned brands are common. A demo call follows. You see a dashboard and numbers that rise. A tiny withdrawal succeeds and builds trust. Behind the screen, the payout is covered with other victims' money. Stage 3 is the upsell. Now the pitch is a larger amount with stronger leverage. Leverage means borrowed money that magnifies gains and losses. Terms like delta neutral or market making appear. In real markets, they can be legitimate. In a fraud pitch, they are noise. You are nudged to move funds fast, often in a stablecoin. Stablecoin means a token designed to track a reference value. Transfers are quick and hard to reverse. A second voice appears as a risk officer to add gravitas. Stage 4 is control of custody. You are told assets sit in cold storage with a multi-signature wallet. Cold storage means keys are offline. Multi-signature means several approvals are needed. In practice, the same team holds the keys. Funds may pass through mixers or light regulation payment processors to slow tracing. The aim is simple: get your money outside normal safeguards. Stage 5 is the profit illusion. The dashboard shows unreal gains. A community chat amplifies the glow. When you request a real withdrawal, holds and fees appear. You are told to pay a tax release or an insurance bond. Compliance is cited to justify delays. Real firms resolve holds with defined workflows. Scammers use holds to extract one last payment, then cut contact. Stage 6 is the pressure spiral. Threats or affection appear. Affinity fraud uses shared identity like a church, a club, or a military unit. A romance or mentor figure urges you to stay calm and double down. You may receive a fake letter that invokes the Securities and Exchange Commission or the Financial Conduct Authority and demands a clearance cost. Every detail exists to keep you in the loop. At each stage, you have a countermeasure. Verify registration and authorization on public databases before any transfer. Request a legal entity that will hold assets and the bank that holds client accounts. Confirm funds are kept in segregated client accounts. Reject screenshots and call a number from an official site. Use a cool-down rule that forbids same-day transfers after a cold pitch. If this script is so polished, what breaks it? The answer begins when one person asks for documents and refuses to let go. That slow insistence changes the balance. South. The unwind starts small. A customer asks for the custodian contract and the name of the bank. The answers do not match the website. A journalist calls the bank and hears that no client money is held. A regulator receives several tip-offs that describe identical scripts. A bank compliance team flags repeated transfers to the same gateway. A blockchain analyst traces flows from the platform to a mixing service and then to an exchange. The exchange receives a lawful request to freeze identified wallets. The community chat goes silent. Marketing pauses. A familiar pattern appears in documents. Client funds and operating cash were mixed. Risk limits were ignored. Disclosure claims were copied from other brochures. Redemption terms were changed without proper consent. Directors approved related party loans that removed assets from reach. An external review that looked like an audit was a paid marketing letter. These findings come from public filings and forensic reports, not rumor. Each point is verifiable on a register or in a court record. Victims try to reverse transfers. Card chargebacks succeed only in narrow cases. Wire transfers are harder. Tokens are harder still. Mistakes are exploited. Email addresses vanish. Support tickets auto-close. That noise triggers escalation. Regulators in the United States and the United Kingdom issue investor alerts and name the entities. Banks exit relationships with the payment processors named in the alerts. Pressure builds inside the scheme. New deposits slow. Withdrawal queues grow. The dashboard claims a temporary upgrade, then a maintenance window, then a security review, finally a suspension. The website returns a gateway error. A message appears that promises a timeline once the investigation ends. It never arrives. The playbook ends with arrests, charges, or civil actions. The words are careful. In early filings, the language is alleged misconduct or alleged misrepresentation. The presumption of innocence applies until a verdict or settlement. For victims, the legal labels do not restore lost savings. They are a path to asset recovery and lessons that can prevent the next loss. The next section shows the consequences in numbers and in lives, and why early detection matters. Often one careful email starts the avalanche. More go. After the freeze and the headlines comes the hard part. Victims face paperwork, shame, and waiting. Recovery begins with fast reporting. Call your bank and describe the transfer. Ask for a recall and record each step. For cards, ask about chargebacks. For tokens, list wallet addresses and transaction links. File a tip with the Securities and Exchange Commission, if a security is involved. Use the Financial Conduct Authority contact center in the United Kingdom. Report to national fraud lines to create a trail for law enforcement. Next comes civil suits and regulatory actions. Courts may appoint a receiver to gather assets and distribute recoveries. Recovery can take years. Be cautious with companies that offer to get money back for a fee. Many are fresh scams that target the same people twice. Use the wait to upgrade your process. Read public filings to see which controls failed. Note the roles of auditors, custodians, and payment processors. Build a standing checklist. Verify registration and authorization before any funds move. Confirm the legal entity name and the client account bank. Ask whether client funds are held in segregated accounts and how long withdrawals take in normal times. Use a cool-down period between a pitch and any transfer. Do not rely on private messages with strangers or on exclusive support channels. Keep independent records of chats and emails. Store confirmations in a personal vault. The aftermath hurts. It is also when stronger habits form. Choose this default to pressure, not yet right. Here are habits that save real money. Slow down when a pitch uses urgency, exclusivity, or flattery. Do not move funds until you verify registration and authorization on official registers. Call a number from an official site, not from a chat. Expect segregated client accounts. Walk away when proof of funds or tiny withdrawals push a larger transfer. Treat dashboards and screenshots as theater, not evidence. Block private message romances and secret mentors. Set a cooldown so no investment happens on the day of the pitch. If it is hard to explain in plain words, pass. Imagine your future self. You kept your savings, your calm, and your choices. For more clear investigations, subscribe to Money Mystery and share. Tell me which case to dissect next in the comments. Stay alert now.